Human nature possesses an amazing, almost self-destructive talent. We love to complicate what is essentially a fundamentally simple game. This isn't just a habit, it's a defense mechanism. Look around, and you will see legions of people wasting their best years complaining. Their favorite mantra, their shield against reality, is the belief that they don't have enough capital to start. They sigh, they whine, they build castles in the air. They postpone life itself for some imaginary later, when, as they think, a real sum of money worthy of their genius will fall from the sky. Let me be blunt. This is all complete nonsense. It is intellectual laziness disguised as prudence. Warren Buffett, a man who understands the nature of money better than anyone alive, spoke about this with disarming directness. He stated that if he had only $1 million to manage today, he would guarantee a 50% annual return. Think about that number. 50%. In a world where people rejoice over the S&P 500 yielding 10%, this sounds like heresy. Most people, hearing this, immediately turn on their skepticism. They think it's the boasting of an aging billionaire or that Warren is just joking, trying to encourage beginners. But I have known Warren for decades. He wasn't joking. He never jokes when it comes to the mathematics of returns. He was simply describing the cold, hard reality discovered by anyone who has ever worked with small sums. Tiny amounts of capital possess the physical property of growing faster because they can slip into places where big money simply cannot fit. This is not an opinion. It is the iron law of markets. And like most iron laws of the universe, whether it's gravity or compound interest, people prefer to ignore it because it contradicts their desires. They don't want to hear that their poverty is an advantage. They want to hear that the system is broken. When you manage billions, as we do at Berkshire Hathaway, the very physics of your existence changes. You are forced to hunt elephants. You need entire herds of elephants. Why? Because when you operate on Berkshire's scale, even a massive profit in absolute numbers barely moves the needle of the holding company's overall return. We have become hostages to our own success. We can no longer afford the luxury of buying small, mispriced securities, sitting orphaned in a corner of the market. Even if such a stock doubles in price, it means absolutely nothing to us. At our size, it is a statistical error. We can no longer be smart and cunning. We can only be big. And yes, being big is a privilege that provides power and influence. But it is also a constraint, and a brutal one at that. It is a straitjacket tailored out of dollars. But look at yourselves. If you are young, if your pockets are empty, but you are hungry for success and armed with a normally functioning brain, you have none of these constraints. You are absolutely free. You possess a mobility that Warren and I can only dream of. You can crawl into the dustiest, most forgotten corners of the market that we were forced to abandon decades ago when our capital became too cumbersome. You can pick up nickels and dimes, small anomalies, tiny pricing errors, the very things we feasted on in our youth before Berkshire turned into a lumbering behemoth. Therefore, if you complain that you have too little money to invest, you fundamentally do not understand the very essence of this game. You are looking at the map upside down. Let's dispel another myth. When Warren and I were young, we didn't have some divine advantage or secret knowledge inaccessible to mortals. We were not chosen by the heavens. We had exactly 3 things: Small amounts of money, plenty of time, and a maniacal willingness to do the dirty work. Warren turned over so many rocks looking for gold that it could well be classified as a major geological survey. I personally observed this process. It didn't look like the glamorous life of a financier from the movies. It looked like the work of a fanatic librarian. He read reports of companies so tiny that their market value probably didn't even cover the printing costs of those very reports. But exactly there, in those cheap brochures, real market mistakes were hidden, and the returns they brought were colossal. People today forget this part of our history. Why? Because it isn't glamorous. It's boring. It smells like dust and printer's ink. People want the myth of the genius, the myth of destiny. They want to believe that Warren emerged from his mother's womb already clutching a completed discounted cash flow model. But he didn't. He came into this world, metaphorically speaking, clutching a stack of Moody's manuals and possessing the willingness to read them until his eyes started to bleed. Here is the real lesson that no one wants to learn. The highest returns in your life almost always happen when you have the least amount of money. It is a paradox, but it is true. Warren, for example, managed to make substantial returns simply on the float from his income taxes. Most people don't even notice that such a float exists. They see taxes as a loss. Warren saw them as a temporary asset. He took the money he owed the government, money that would eventually have to be paid, and invested it in short, precise bursts into opportunities that yielded more profit than the tax amount itself. Just imagine the audacity and beauty of that maneuver. Earning on a temporary pile of cash enough to pay off the government, using the government's own future check. To the uninitiated, this sounds almost like a magic trick, sleight of hand. But it wasn't magic. It was simply a man playing a very small game, but with extraordinary intensity. Try pulling off a trick like that with $100 billion. You can't. Opportunities of that kind simply do not exist at that scale. The market does not create billion-dollar inefficiencies that can be exploited without risk. That is why Warren once joked that if he were managing a tiny sum again, he would make 50% a year. And I'll let you in on a secret worth remembering. He wasn't exaggerating. He was being damn modest and conservative in his estimates. The tragedy is that the people most capable of achieving such returns, the young, the hungry, the beginners, are the ones who least believe they are capable of it. They are young. They lack self-confidence. They are surrounded by information noise screaming at them. Wait. Accumulate capital first. Become established first. As if waiting will magically teach you rationality. As if you can accumulate the temperament needed for investing simply by doing nothing and staring at a growing bank account balance. That is a lie. In reality, your best chance to become a good investor is to work with small sums and make small, survivable mistakes. Understand the difference. A small mistake with small money is the price of tuition. A huge mistake with big money is a destiny-destroying tragedy. That is life, and that is the math. And yet, despite all logic, the average person continues to whine. Charlie, I want to start investing, but I only have a very little. My answer is always the same. Well then, you have an advantage. You can buy what the giants cannot even touch. You can enter and exit positions, and no one will even notice your presence. You are a ghost. You can exploit opportunities precisely because, to the rest of the world, They look insignificant and unworthy of attention. Warren once said, "We used to look under a lot of rocks." He was being polite. We practically lived under those rocks. We were the dungeon dwellers of Wall Street. But that is exactly how small money turns into big money. Not through some flash of genius, not through forecasting GDP, and not through listening to an advisor's tips about which emerging market is hot right now. Capital grows because you are agile enough to pick up opportunities that are too small for the elephants. If you manage $5,000 or $20,000 or even $100,000, you are not falling behind. You are not a loser. You are simply operating in a completely different ecosystem. An ecosystem where inefficiencies are found at every step. And inefficiency is the oxygen for compound interest. Let me draw a blunt conclusion, the very kind I am known for, and that people hate to hear so much. If you are poor in your 20s, you are not disadvantaged. You are armed. You have the exact thing that Warren and I would pay a fortune to get back. You have the ability to multiply small sums in places where no major player can stick their nose. Most people waste this golden period, whining that they are not rich yet. They fundamentally do not understand the nature of their own opportunity. And the markets do not care about your feelings. They absolutely do not care whether you think life is fair. Markets only care about your behavior. If you behave rationally with small sums, you can grow them in ways that become physically impossible once you get big. That is the irony. And like most ironies in life, it favors those who stop complaining long enough to simply see it. If you want to understand why small money grows so well, you need to understand a simple geometric truth. Big animals cannot squeeze into small holes. It's not because they are stupid, it's because physics won't allow it. The exact same logic applies to markets. When you are managing $10,000, $50,000, or even a couple of $100,000, you are practically invisible. You can slip into small opportunities, into weird little situations, into tiny pricing mismatches that a large fund cannot even officially acknowledge. They literally cannot. It is not part of their ecosystem. For Warren and me, these little corners of the market were once our primary hunting grounds, and we hunted there ruthlessly. We were not ashamed of it. We did not pretend to be geniuses of global macroeconomics. We made no grand declarations about the future of China or the fate of the Fed's interest rates. We simply collected small mistakes that no one else wanted to bend down for. People today think investing is all about vision, insight, and strategy. I have lived a long life, and I will tell you this. Most of the best returns come from finding human stupidity and exploiting it before it disappears. And stupidity is usually found in small places because that is exactly where most investors never bother to look. Take odd lot tenders, for example. Hardly anyone under 40 even knows what they are. But in the early days, they were free money just lying on the sidewalk. You only needed a small position to trigger the tender, and most large investors couldn't afford to waste time on such trivia. Too small, too tedious, too marginal. But Warren didn't think so. He saw dollars where everyone else saw dust. Or consider thinly traded stocks. Small businesses worth $2 or $5 million that serious analysts hadn't looked at since the Eisenhower administration. That is where inefficiency lives. That is where you could buy a dollar for 50 cents. Not in the overanalyzed darlings of the public that dominate the CNBC airwaves. When you are small, you have a luxury that big funds envy. You don't have to explain your actions to anyone. You have no committees demanding a PowerPoint presentation. You don't have to explain why you bought a weird little company whose entire workforce could fit into a school bus. You can just go and buy it. A large fund, meanwhile, couldn't even initiate a phone call. Their compliance department would faint. That is why I laugh when young investors say, "Charlie, I wish I had more capital so I could invest better." No, you don't. You currently have the best capital profile you will ever have. You just haven't realized it yet. People look at Berkshire today and imagine that we have always allocated capital in billion-dollar blocks. That is ridiculous. In the early years, Warren bought things so small that if he tried to buy them today, we would need a microscope to see them on our balance sheet. And that is no joke. The company grew too big for its own past. When you manage a fortune, your investment universe shrinks. You are forced to abandon the tiny opportunities that once defined your success. The irony is almost poetic. The bigger you get, the fewer places you can go. You turn into an economic elephant. Majestic, yes, but forever stuck on the same beaten paths. Meanwhile, the small investor is a fox, darting back and forth in places the elephants don't even know exist. Let me give you an example. Imagine a small company with a market cap of $30 million. Maybe it makes specialty glue. Maybe it processes fish guts. It doesn't matter. The point is that no one is writing glowing research reports about it. No hedge fund manager is bragging about owning it at a conference in Miami. But the company has real cash, real earnings, and the stock trades at 5 times annual earnings simply because no one has bothered to check if it's even alive. You, with your $20,000 portfolio, can buy that. A massive fund managing $50 billion cannot. Even if they buy the entire company outright, it would still be irrelevant to their overall return. They have no incentive to look there. You do, and that gives you the edge. But here is the problem. People want glamour. They want to buy exciting, popular things. They want a story, not a bargain. They want Tesla, not a fish gut processor trading at 5 times earnings. That is exactly why most people never outperform anything. They are too focused on feeling smart instead of being smart. When you are small, the entire key to success is abandoning the thirst for glamour. You must operate in the shadows of the market, not in the spotlight. You must look for what is neglected, not what is celebrated. You must think like a junk dealer, not like a celebrity. And don't tell me there are no opportunities. The world is full of small inefficiencies because people are eternally inefficient. They get bored, they get distracted, they chase fads, they miss the obvious. This is not a temporary condition. It is the permanent state of the human species. And this permanent stupidity creates permanent opportunities, but almost always on a small scale. Large funds cannot exploit this. You can. So, if you find yourself in your 20s with a 4 or 5-figure portfolio and think you are falling behind, let me correct you. You hold the only lottery ticket that actually works. It's called being too small to be noticed. You can go where the mistakes lie. You can act on them. You can do it quickly. And you can compound capital at a rate the giants can only dream of. Someday, if you are lucky or persistent, you might become too big to play this game. But don't rush that day. The best returns of your life happen before anyone knows your name. And if that doesn't motivate you to stop complaining and start looking under rocks, then nothing will. People have this charming fantasy that the richer you get, the easier it is to multiply money. Reality doesn't work that way. In fact, it is the exact opposite. The richer you are, the fewer opportunities you have. Wealth solves a lot of human problems, but high investment returns are not among them. At massive scales, the world becomes too cramped for you. Warren and I have talked about this endlessly. Berkshire receives billions, not millions, but billions of dollars every year that we are obligated to allocate. It sounds fun until you actually try to do it. Then you discover it's like trying to feed an elephant by gathering ants. You simply cannot gather enough of them to make a difference. So, you stop trying. When Warren said, "If I had $1 million, I could make 50% a year," he wasn't being coy. He meant it. And the unspoken continuation was, "But with hundreds of billions, we'll be lucky to beat the index by a hair." This is not a lack of skill. It is math mixed with physics and a dose of common sense. If you have ever tried to change the course of a massive ship, you will understand the problem. A small boat turns instantly. A giant aircraft carrier needs miles. Investing is the same. When you are small, you can change direction in a single day. When you are big, even if you see an opportunity, you often cannot reach it without collapsing the floor beneath you. Take a tiny company worth $20 million trading at a ridiculous price. Maybe it's worth twice as much. Great. But if we at Berkshire try to buy even $200 million worth of its stock, the very act of buying will drive the price into the stratosphere and destroy the value. Our own size kills the opportunity. So what do? We stop looking at such companies altogether. That is what people don't understand about scale. Eventually, you have to close the door on the most profitable hunting grounds of your youth. Not because you are too smart for them, but because you are too big for them. Warren and I did not abandon small, undervalued stocks out of arrogance. We abandoned them because they became impossible. That is why, when young people tell me they wish they had more capital, I laugh quietly to myself. Politely, of course, because they are wishing away their own advantage. Let me explain the problem even more clearly. If you are managing $10,000 and you find a tiny opportunity that yields 30% in a month, you can buy all of it without muddying the water. Congratulations, you have captured a wonderful inefficiency. If you are managing $100 billion and find that exact same opportunity, it might as well be located on Mars. There is no way to deploy enough capital into it to matter. Even if it instantly doubles, you've added maybe 0.003% to your portfolio. It won't even register on our calculators. This is exactly why our returns over the decades have naturally declined as Berkshire grew. The world simply doesn't produce enough undervalued elephants. And believe me, we've looked. We've hunted everywhere. We found some, but nowhere near enough to recreate the insane growth of our early partnership days. Warren once described our partnership returns as almost unfair. They weren't unfair. We were just small. That is the part the public constantly forgets. They want magic without acknowledging physics. One of the most enduring illusions in the investment world is the belief that you need a grand theory about countries, continents, or global trends to make money. People love these grand narratives. Emerging markets are the future. China will dominate. India's middle class will explode with growth. It all sounds very intellectual. It also has almost nothing to do with making good investment decisions. Warren and I have never once started our day by saying, "Let's focus on Brazil today," or "Let's target China this quarter." Not once. We never said it because it is a stupid way to think. The world is too big and unpredictable to be approached with such broad generalizations. And frankly, we know that we are not macroeconomic forecasting geniuses, and neither is anyone else. But macro commentary sells well. It sounds impressive, it sounds global, authoritative, even visionary. People swallow it because it gives them an illusion of control. And investment advisors love this appetite. It keeps them in business. I've always said, if a pitch sounds like it belongs on a TED Talk stage, it probably has nothing to do with smart investing. The truth is painfully simple. You become a successful investor by finding a good business at a good price. Nothing more glamorous than that. You don't need a worldview. You don't need to forecast GDP. You don't need to guess which country will grow the fastest. None of this is required. And most of the time, it is harmful because it fills your head with noise. Let me illustrate the absurdity. An advisor tells you that Bolivia is the next great frontier. You ask, why Bolivia? Last year he talked about Sri Lanka. Next year he'll talk about Vietnam. It never ends. These people are not investing. They are touring the world with PowerPoint slides. Warren once joked that if someone starts forecasting by country, they are probably better at selling than investing. He wasn't joking. Actually, he was just being polite. I'll be blunter. When someone speaks too broadly, it usually means they understand nothing deeply. The world does not reward broad theories. It rewards specific insights. I am not saying we avoid foreign investments. We own PetroChina. We owned BYD. We bought securities all over the world, but we bought them for only one reason. They were good businesses, run by competent people, selling at reasonable prices. We didn't buy them because they were Chinese, or because some consultant told us Asia was the new frontier. We bought them because, at that moment, the math made sense. Math is universal. National narratives are not. Most young investors do the exact opposite. They start with a narrative. They want to say they are investing in the rise of India or the modernization of Africa. It sounds bold. It sounds global. It sounds smart. It is also a distraction from the only question that matters. Is this specific business worth more than the asking price? That is the whole game. Everything else is theater. Another problem with macro thinking is that it seduces you into overconfidence. If you say China will grow, you suddenly feel like you have solved some profound puzzle. But growth does not equal investment return. Japan grew impressively after the war. The stock market still delivered decades of dead money. China's GDP grew like a weed. And yet, many Chinese investors went broke, buying the wrong businesses at the wrong prices. Growth itself is useless if the price you pay already assumes perfection. Now let me explain why this is so critical for small investors, the group I am supposedly addressing in this little sermon. When you are small, you do not have the luxury of being stupid. You cannot afford to chase hot trends or macro stories. You don't have the capital to insulate yourself from your own ignorance. Every mistake costs too much. Therefore, you must act with clarity. You must cut out all the noise. You must think in the simplest terms. Is it cheap? Is it durable? Is it well managed? Does it make sense? That is investing. Everything else is stamp collecting. There is also another advantage to ignoring macro forecasts. It keeps you from acting like a tourist. Tourists move in herds, go where they are told. and pay overpriced rates for everything. Investors who chase macro narratives behave the same way. They crowd into the same hot sectors, the same growth regions, and overpay for the privilege. We prefer to act like locals, quietly, selectively, and only when we see something that truly makes sense. Most of the time, nothing makes sense, so we do nothing. This is another discipline that young investors rarely master. They think they have to be active. They think they have to have an opinion. No, you don't. Sitting still is an underrated skill. Let me give you a simple mental model. If an idea sounds like it was crafted to impress a room full of dilettantes, it is probably worthless. Professionals don't need to sound brilliant. They just need to be right. And here is what being right usually looks like. Buying a solid business at a price that discounts its future cash flows, holding it long enough for compound interest to work, and ignoring the noise machine in the meantime. You don't need a passport to do this. You don't need a macro thesis. You don't need a geopolitical lecture. You simply need discipline and the willingness to say, "I don't know," when a topic falls outside your circle of competence. Warren and I never pretended to know the future of nations. We barely pretend to know the future of a company. We just focus on whether the company is undervalued relative to what it will likely produce. That alone has saved us from an enormous amount of foolish behavior. If you can learn this lesson early, you will avoid a colossal amount of stupidity, which in my opinion is the true definition of success. And if you ever find yourself listening to an advisor saying, "Now is the time to invest in emerging markets," do yourself a favor. Check your wallet, because the only emerging that will happen is likely the disappearance of your money. Every young investor at some point asks the same question. How do I raise capital if I don't have a track record of success? I will save you some time. You probably can't. And you probably shouldn't. We live in a world where everyone wants to manage money precisely because the fee structures are absurdly generous. The 2 and 20 model. That's 2% for management and 20% of the profits. Yes, it can turn even a mediocre investor into a rich person. If you manage a fund poorly enough, you can still get rich. It is a perverse system of incentives. It attracts the wrong people, those who want money more than responsibility. So the first thing I tell young people is a brutal simplicity. If you want to manage money someday, start by managing your own, and do it very well. Not in theory, not on paper, not with imaginary portfolios or hypothetical trades. No one respects that. You need a real, audited, verifiable record of capital that belonged to you, where your mistakes genuinely hurt, and your success actually meant something. Warren said it best. Start building an audited track record as early as possible. That advice is worth more than any financial degree you can buy. People underestimate how much trust it takes to hand your money over to someone else. Even family members should be careful. Most track records aren't worth the paper they're printed on. Half of the great returns you read about come from survivorship bias, selective reporting, or pure blind luck disguised as genius. If you put 300 million orangutans in a room and have them flip coins for a week, some of them will flip heads 10 times in a row. That doesn't mean they are skilled primates with advanced predictive abilities. It means you are watching statistics in a carnival costume. Most investors with an excellent track record are no different from lucky orangutans. They caught a wave in some specific cycle and then spent the rest of their lives selling that lucky streak as proof of mastery. So, yes, if you are young and trying to raise money, Don't start with a promise of genius. Start with proof of competence, slowly, quietly, over time. That is the only kind of proof any rational person should trust. When Warren started his partnership, he didn't have a crowd of investors begging to take their capital. He scraped together about $100,000 from close relatives, and even then, some of them thought he was running a Ponzi scheme. That tells you something about both human nature and capital allocation. If your own family is skeptical, imagine what strangers must think. Another thing people don't like to hear is this: raising money should be hard. Money shouldn't be handed to you just because you made a beautiful presentation or have a vision. Managing other people's money is one of the most serious responsibilities you can take on. You are dealing with people's life savings, their futures, their children's college funds, their retirements. If you think you are entitled to this privilege without having demonstrated a decade of responsible behavior, you are delusional. Warren and I study the people we hire with almost absurd scrutiny. It's not because we like being difficult. It's because the world is full of smart people who still manage to lose money in spectacularly stupid ways. Intelligence is not enough. Education is not enough. A few lucky years are definitely not enough. We want to know if a person succeeded because of their thinking or because of a fluke. Do they have a repeatable process or just a lucky streak? Can they explain their decisions clearly instead of drowning you in jargon? If they cannot explain what they are doing in plain English, they probably don't know what they are doing. This is where most young managers fail. They try to impress people instead of educating them. They speak in theory instead of showing evidence. They want authority without earning responsibility. And here is what is even more uncomfortable. The only people who are likely to give you money early on are those who already trust you in some other context. Friends, family, a boss who has seen your work ethic, a mentor who believes in your character more than your Excel spreadsheet. That is how almost everyone starts, and that is how it should be. If you are 25 and think you are going to raise millions from strangers based on your brilliant insights, let me gently reset your expectations. You haven't convinced me, and I am not easily convinced, because I shouldn't be an easy client. The investment world is full of people who sound good and deliver nothing. If you want to stand out, stop trying to sound good. Start becoming good. Build a record that speaks louder than your pitch. And remember something else. Management fees distort incentives. They attract people who want to seem qualified rather than people who want to be qualified. The compensation system is structured in a way that encourages risk-taking when the upside goes to the manager and the downside falls on the investor. This is, at best, morally questionable. Warren once said that if our two internal managers worked under the standard fee structure of a hedge fund, they would each be making $120 million a year, even if their investment decisions were so bad they might as well have buried the money in a hole. Think about that. Getting rich, destroying value for your clients. A completely legal transfer of wealth disguised as investment mastery. If that doesn't bother you, it should. So, here is the sober truth, served without honey. If you want to manage other people's money someday, spend the next decade building a real track record. Prove you can protect capital. Prove you can avoid stupidity. Prove you can explain your thinking clearly. Prove you have integrity. And even after all that, raising money will still be hard. Good. It should be. Accountability without friction creates fools. Accountability with friction creates adults. Choose which one you want to be. If there is one message that young investors constantly fail to grasp, it is this: your lack of money is not your flaw, it is your competitive advantage. People don't like to hear that. They want scale, they want prestige, they want to manage billions, they want to feel important. But the market doesn't reward feelings, it rewards structure. And structurally, small capital outperforms large capital in generating extraordinary returns. When Warren talks about making 50% a year with small sums, people react with disbelief. They think he is telling a fairy tale. They want to argue. They want to catch him on some modern financial theory. But he is simply describing what we went through and what many young investors today could still experience if they stopped trying to act like miniature hedge fund managers and started acting like rational adults. Let me be clear. Compounding tiny sums of money is the closest thing to financial magic you will ever see in your life. But it only works when the sums are still tiny. The moment the numbers get big, the game changes forever. You lose flexibility, you lose speed, you lose stealth, you lose access to the mispriced scraps that once fed you. And the grim irony is this: the moment you finally become big enough to impress people, you are no longer capable of earning the returns that made you impressive in the first place. That is exactly why I keep hammering the same point home. Your 20s are not a waiting room. They are the golden years of compound interest. The years when your capital is so small that every inefficiency matters. The years when you can buy into situations too small for professional investors. The years when your mistakes are survivable. The years when an entire universe of micro-opportunities is open to you. Someday, if you succeed, that universe will close. It always happens. Young people fantasize about managing money the way Berkshire does today. They imagine themselves sitting in some quiet office, making billion-dollar decisions, but they completely misunderstand the trade-off. Big money looks glamorous, but it is, by necessity, slow, constrained, and cornered into narrow hunting grounds. Small money is nimble. Small money is invisible. Small money can go anywhere. Small money can generate ridiculous returns because it can still slip into ridiculous opportunities. Warren used to find opportunities so trivial that no organization could even process the paperwork for them. And yet, those little anomalies were sometimes the most profitable investments of his entire year. Percentages, not appearances, create wealth, yet most people choose appearances. Let's talk about human nature for a moment. People don't chase high returns. They chase prestige. They chase strategies that look sophisticated. They chase narratives they can brag about. They want to sound like global macro thinkers. They want to imitate hedge funds. They want to play big. Meanwhile, the real big players secretly wish they could still play small. If you take nothing else from this entire discussion, remember this: the best returns of your life happen when no one knows your name and no one cares what you are doing. The moment people start caring, the party is over. You might think this is discouraging. It is not. It is liberating. It means you don't have to wait for success to start compounding capital. You don't need a fortune. You don't need a reputation. You don't need permission. You just need discipline and the willingness to exploit opportunities that are too boring or too tiny for everyone else. It also means you have no excuses. You are not too small You are not too early. You are not under-resourced. In fact, it is exactly the opposite. If you squander the tiny capital phase of your life, you squander the only period when extraordinary returns are structurally possible. And here is what most people will not admit out loud. The average person wastes their compounding years on distraction, vanity, and macro nonsense. They spend more time trying to sound smart than trying to avoid stupidity. They chase predictions instead of bargains. They want to feel like investors rather than acting like them. Warren and I were not born brilliant. We simply didn't waste our early years. We bent down and picked up the opportunities lying on the ground. They were too small for anyone else to bother with. But they weren't too small for us, and that made all the difference. If you are going to imitate anything from us, imitate that. Not the Berkshire-scale deals, not the public prestige, not the mythology that has accumulated over time. Imitate the early years, the part that no one glamorizes because it involved turning over metaphorical rocks, reading footnotes, exploiting small pricing mistakes, and compounding embarrassingly small sums into something meaningful. Humility builds fortunes. Ego destroys returns. And nothing exposes the ego faster than the desire to skip the small game phase. True investing is rarely exciting, but it is almost always rational. So let me end with a phrase for which people accuse me of being overly blunt. If you are young and poor, congratulations. You are in the sweet spot of compound interest. It will never be this good again. Do not waste this time wishing you were already rich. Use it to become rich. And remember, the world rewards patience, rationality, and the avoidance of stupidity. Everything else is marketing.